Hello, everyone, and welcome back to another episode. I will be talking today about universal life, whole life, and term life, and trying to give you a basic understanding of the differences, what they're good for, uh, why you might choose one over the other. So, right now, I am still getting ready, but I will be going very, very soon here. So, just give me a couple moments. Okay, so we are just about there, and you can already see behind me my little note board. Push the chair out of the way and get to the proper side. Okay, so as I mentioned, we will be going over the different types. There's two main types. There's term and permanent. Now, with term, it's just like it sounds. It terminates. It can be a 5-year, 10-year, 20, 25-year, didn't write it, but or 30-year. 30 years are really good for mortgage protection for people that go out and buy their first home or buy a home that they have a mortgage on. The shorter terms are good for people that are getting closer to retirement, maybe. Maybe there's 20 years out, 10 years out, whatever the case might be, that you're going to decide, okay, well, I need to replace a large amount of money if I die within the next X years. Okay? It's a guaranteed premium. So you're going to pay one amount per month for the entire term. Now, when I say guaranteed premium, I am going to say it's an adjustable guaranteed premium. All right? So, like I said, for the period only. It's a guaranteed benefit. So if you were to die during that time frame, whether it's a 30, 20, 10, or 5, your beneficiaries would get the agreed upon death benefit. All right. Now, if we switch over to the permanent side, you have your index universal life, your guaranteed universal life, and your whole life. Okay. So with your index universal life, guarantee rates can be as low as 0%. They have flexible premiums, flexible death benefits, but their growth potential is quite a bit higher. Okay. GUL, just like it sounds, it's a guaranteed universal life. It's going to be that dollar amount for that premium for X number of years, whether you're paying to 100, paying to 121, whatever the case is. All right. Now, whole life, you can choose to pay to. So you can choose to pay to year 20, pay to year or till age 100. Whatever the case is, you get the choice. You get possible dividends. They're not guaranteed dividends, but you can have dividend growth. And you do have a guaranteed cash value within a policy. All right, and if there's any questions out there, whether you're live, just go ahead and comment. Or if you're not live, if you are watching this after the fact, then please feel free to shoot me a message either on Facebook or at my email address, tim@adkinsure.com. One second here. I can't see who's here and who's not here. Just got to finagle Facebook a little bit. Okay, there we go. All right, so as I was saying, you have your whole life paid to year 20 is going to be the illustration I did. Can be paid to year 100, 101. And it's more of a guarantee. The guarantee rate is a little bit higher, but the potential for growth is not there is not nearly the same as IUL or GUL. They're all great products. So the term, you're looking at a period of time, 5 to 30 years, where someone is going to receive a larger death benefit. It's a lot cheaper within that time frame. Permanent products, you have your IUL, GUL, two sides of different coin. You have a guarantee rate with IUL that's as low as 0%, and it's a flexible premium, flexible death benefit, meaning if you have extra money, you can pay that in. All right, and that will grow the death benefit. That'll help grow your cash value. If you have less money, you pay less in, and it's going to take from the cash value or reduce your death benefit. Okay. So I just have a quick illustration here for a 35-year-old female. And again, this is not a, perfect. This is not a quote. This is just to get you an idea. Just need a glass of water here. Hey, Ken and Nicole. If you guys have any questions, please write it down in the comment section. Let me know. So, 35-year-old female, no medical evaluation, just questions. First, that 30-year term. From year 1 to year 30, this will be $832 per year. All right. Year 31, it's going to jump up. I am missing a number there. Let's see if I still have my notes. Let's see, year 31. I do not seem to have those notes. So let's ignore this. Year 35 jumps up to $6,305 per year. Year 65, which is age 9,900, depending on when it falls, $172,274 per year. So with the term policy, it's great for the short term. It's great for a period, but it does terminate. That guaranteed $832 a year ends after 30 years or whatever term you decided. Hey, Jimmy, if you have any questions, feel free to reach out to a comment in the message section or in the comment section. So it does get very expensive to continue. You can also convert it. You get credits at the end of the term. Normally it's within X number of years of the end of the term. It has to be converted from a term to a permanent product. And you get a small reduction on your costs. Then you have the universal life. Now this is a IUL that I did. All these are from the same company. So year 1 to year 55, $2,369. Okay, that's going to be your annual payment. So higher than the 832, but it's level 90 years. Now the downside, at the guaranteed rate, unless you're going to pay more in per year, then at age 90, it ends. No more insurance. Hey, Alice, if you have any questions, just feel free to write them in the comment section. So at age 90, this guarantee ends. Non-guaranteed, up to continue it to age 100. You can get, with this payment, non-guaranteed, $492,744 in death benefit. That's not guaranteed. I personally am a little more conservative. I like to work off the guaranteed numbers for my clients and for myself. So this right here really concerns me. Now, if you're in a job where you know you're going to get a raise, you know it's going to be you're going to have extra money to spend later on, feel free to, to talk to me about this, I'm more than happy to. It's a great product and it can be used for retirement. What that means is there's going to be a strong cash value, as you can see, with that death benefit growing. This is only when it grows on. With that death benefit growing to $492, that's been taken from all the earnings found within the policy. So what you can do is then take out, as a loan, tax-free, the earnings on your policy and use that to live off of for however many years, depending on the dollar amount. We're looking at a cash value of $492 or 200, whatever it is you need to survive, that's what you'll have. Hey, Will, thanks for joining. If you have questions, please let me know. Just write them in the comment section. Now, whole life. This is a lot safer. So it's better for people that can't really afford to lose life insurance. They can't afford to pay additional throughout the 90 years or 100 years. So year 1 through 20. As I said, I did this as a 20-year pay. It's $4,937. Sounds like a lot of money. But as of year 21, you're not paying anything. Permanent product, whole life, you're going to have it for the rest of your life. It's a higher premium amount, but your payments stop at year 20. Now, for this situation, 35-year-old female, she's getting ready for retirement at 55, maybe 10, maybe 15 years left. But she's starting to think about retirement, starting to get ready to put money aside, in addition to what she's already had in a retirement account. To have an extra $4,937 a year to put in towards retirement versus your insurance policy would be a huge benefit. All right. So again, they're good for different things. Universal is great for if you want to plan for your finances, plan for the future. Whole life is great for that guarantee. It's a guaranteed death benefit, guarantee amount. Doesn't change. And as you can see, year 21, I can make it so you have no payments at all. Term, I recommend for younger people. A lot of times I'll recommend a term policy plus a whole policy. And what that does is that gives that high death benefit at a very low price, $832 for 30 years, or even less for fewer years. You mix that in with a whole life policy that you're going to have forever, and all of a sudden you have a very strong policy or mix of policies that's going to allow you to ensure your family, your loved ones are covered, whereas one or the other may or may not fit your needs. By combining, they're going to be able to fit your needs both in the short term and the long term. Okay. Now, as I mentioned, there are different prices, and because term changes the entire time, I'm just going to say that $172,000 a year, but it does increase. So you're paying $832 a year for 30 years. I think that was supposed to be $1,400 or $4,000 and change, and then $6,000 and change, all the way up to year 65, paying $172,000 and change. All right. So you can see where the cost comes into play and how expensive it can be if that's what you have and that's what you're keeping. Now, if you were to use the universal life, paying the $2,369 until age 90, that's $129,600.60 that you're paying for the $250,000 in coverage. So you're still getting decent return, as long as you're able to have an increase in the index that it's tied to. Whole life, paying $49.37, paying that up front, paying that while you're still making money, while you're still earning income, and then stopping at year 20 comes out to $98,740 and change. So even though this is the most expensive on the board, it actually is the cheapest to continue. It's the cheapest to ensure that you're covered until you pass away. All right. Now, if there's any questions, I'll be more than happy to answer them. Welcome, James. I hope you enjoyed this. I hope you guys enjoyed it, the presentation, and learned a little something. Doesn't look like there's any questions. I am going to wait a minute just until the video catches up. Next week, I'm going to have a special Facebook Live. Instead of me boring everyone with life insurance or insurance facts, I'm going to be talking with Sandra Geddes from Meadowbrook, and she's going to be telling us all about the different activities, the different types of assisted living that they have. She's going to explain Meadowbrook in full detail. Even though I do sell long-term care, I'm not talking about that next week. It's not going to be any insurance. It's only going to be Meadowbrook. All right. So it looks like there's no questions. Hope you guys have a great night, and I will see you next week.